I think when gold gets above that 2,400 ceiling, that it's defined 3 months in a row, meaning it's a happy level. It's not thin air up here for gold. Thin air is like the 2011 peak. Go back and look at it. When you hit 1,920, you collapsed. You could never even get back to 1,800 after that. Okay. Then look at the 2020 high in the year 2020 when we traded up to 2,070. When you dropped from that high, it took you 2 years to get back to that 2,000 level again. Okay. This time we hit 2,400, pull back, 2,400, 24. Something's going on here that says, no, it's not thin air up here. The market's quite comfy. So people who think it's overbought, I think, are totally wrong. This is just a mild congestion zone. And when you get above that 2,400, especially 2,500, I think you'll see some drama that most people will be surprised by.
Gold's lightning rally to successive record highs shows every sign of continuing in the second half of 2024, as the fundamental case for bullion remains firmly in place, though $3,000 per ounce looks just out of reach, traders and industry experts said. Investors have flocked in droves towards the precious metal, driven by expectations for monetary easing, geopolitical tension in Europe and the Middle East, and, most notably, central bank purchases led by China. From a technical perspective, MichaelOliver, proprietor of Momentum Structural Analysis, stresses the value of a long-term investment in monetary metals rather than short-term trading. He highlights his bullish stance on gold since February 2016 and recent momentum breakouts in gold and silver. Gold and silver prices have stabilized so far this week after seeing a sharp drop on Friday. With the latest US CPI report and Federal Reserve meeting taking place today, however, there could be further price movement to come. In his analysis, Oliver notes that despite intra-month fluctuations, gold's monthly closes have trended higher since April, indicating stability rather than a significant correction. He dismisses a recent 2.5% decline in silver as minor and reiterates their bullish stance on silver. He highlights silver's strength and expresses confidence in the ongoing upward potential of monetary metals, noting increased favorability among asset managers. Silver price clings to key support of $29 in Friday's American session. The white metal rebounds as U.S. bond yields come under pressure due to improved speculation that the Federal Reserve will start reducing interest rates from the September meeting. 10-year U.S. Treasury yields have dropped to near 4.20%. Lower yields on interest-bearish assets reduce the opportunity cost of holding an investment in non-yielding assets, such as silver. However, Oliver believes the recent pullback below $30 is insignificant, as most highs were in the mid to upper $20. Now, we present the clips of MichaelOliver's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Well, when you look at those charts, the action of gold month-to-month closes. Now, we urge people that if you're an investment, have an investment position in the monetary metals, not a trading position. You're looking out. We got bullish in February 2016 and haven't altered our view. At that point, gold was 1140. But we've now recently reemerged in gold. We all know that. You can even see it on a price chart. But we saw the breakout on long-term momentum of gold and silver back in March and April. At that point in time, silver was coming up above 25, which didn't look particularly important on price charts. And in the case of gold, it was coming up at that 2,000 level again, where it had been a couple times before in the last several years. And we knew that it was about to launch again. Well, when you look at the gold monthly closes, there hasn't been a down close yet, including this month. The last April, we've had a high close, May a little higher, and June is still a little higher. There has yet to be a down close. So everybody who thinks there's this big correction going on, intra-month there have been some gyrations. But when you stand back and look at the bigger picture, it's just steady as a rock. In the case of silver, you had your peak monthly close last month, and right now this month we're down 2.5% on the month. Wow, big deal, okay? Again, we got super bullish again just above 25 back in March, April. And so we're getting a pullback, and right now we're trading just below 30. And I'm going to argue this case, that those who've been doubting gold and silver for the last 3 or 4 weeks, thinking, we're going to have a multi-month correction and we're going to drop back to 26 silver and gold's going back to 2,000. If gold gets back over that 2,400 mark again, now 3 months in a row, it's traded over 2,400, April, May, and June. That's not a top. When gold tops, it makes a high and doesn't come back to it. We've gotten over 2,400 3 months in a row, which shows that it's comfortable. You get back over there again, I think you're going to launch gold in a more dramatic way, even, where you might be over 3,000 very rapidly, and silver like as well, leading the game. In fact, if you look at silver, gold's trading below its April high intra-month. April, May, and June have all reached 2,400. So it's just consolidating sideways when you look at a bar chart, including the highs and lows. In the case of silver, we're out above the April high. So silver's actually been stronger than gold, despite the recent intra-month pullback in silver. So I think the monetary metals are the place to still be. I think the big move is still underway, has really yet to expose itself. And this time around, I think a lot of asset managers are looking at it favorably over the past few months especially, and also T-bonds. If you look at silver's highs since 2020, just on a bar chart, not that chart I sent out, which is the monthly close only, but if you look at a bar chart, you'll see there was a brief spike above 30 that occurred in 2021, very brief. I don't think there are any monthly closes up there. And then you retreated sharply, whereas gold had flat ceiling, got over 2,000, 2020, got over 2,000 again in 2022, got over 2,000 again in 2023. So it had a flat ceiling. Silver, on the other hand, had descending highs. While gold was going sideways, silver made lower and lower highs. So that 30 was the topmost peak of the pattern of descending highs. In fact, its last set of highs that it broke through was at $26. So we haven't even pulled back to there, and I don't think you're going to. Okay. So pulling back below 30 is not technically important. That's one single isolated old high over there that lasted, I think, a week. Okay. But most of the highs in silver since 2020 have been in the mid to upper 20s, not at 30. So it's not technically important. I know a lot of people think it is, but it's not. And I strongly suspect that the pullback we had in silver this week was it. That was the low, I believe. That was 28.73. Right now we're trading 29.60 something as we do the interview.
During the interview, MichaelOliver mentions that gold is driven by currency depreciation, not geopolitical tensions. He predicts that central banks will devalue currencies during stock market crises, hence boosting gold prices. Gold's new high signals that global central banks are likely accumulating the precious metal in an effort to diversify away from the dollar, as persistently large fiscal deficits threaten to further erode its real value and lead to more inflation. Gold's recent move has been broad and pronounced, with the precious metal making 50-year highs against 3/4 of major DM and EM currencies. While shifting focus to the next aspect, Oliver says Powell's positive outlook on banks contrasts with the FDIC's report of 63 problem banks and $500 billion in unsecured debt at risk. He believes banking and real estate have yet to recover from last year's crash and predicts further declines in commercial real estate could significantly harm banks. Let's get back to the interview.
I think that I'm not concerned about the geopolitical tensions such as the threat of war. So I don't think that's an issue. In fact, in my history of knowing gold since the mid-'70s when it was legalized, it's never really responded to a war event. There might have been a war event here or there, but it really wasn't part of a driving force behind gold. What drives gold? It's money. And when you depreciate the money units by which you value price gold, whether it's in euros or yen or dollars, and that unit of money is depreciating in value continually, gold goes up continually. It's as simple as that. And when you have a crisis that's pending, especially in certain asset categories that central banks don't want to see go down, stock markets, that's when they'll depreciate the money even more in their effort to put out the fire. They'll flood it with the new river of liquidity, lower rates, and so forth. And you can bet they're going to do that. And the one spark that always gets them going is when their stock markets break. And I think that's what's pending. Now, I mentioned the structure on T-bonds on momentum. You don't see it so evident on price, but on momentum, we have this massive ceiling, which we've hit and hit and hit for 2 to 3 years now. And when you go through that, and you're going through it right now on momentum, you're going to launch. What Powell says is one thing, but the FDIC said in a report this week, there are 63 banks that are problem, quote, banks. And there's like $500 billion, if I'm not mistaken, in unsecured debt that is in jeopardy in the banks. Now, Powell didn't mention this. His only comment was the banks look good. Okay. So what happened last year that you're talking about, which was a mini crash, actually. And by the way, they never really recovered from that. If you look at the bank sector or look at RWR, the real REIT sector, very important sectors. Yeah, they bounced off their low, but they're nowhere near back at the 2022 highs. They're laying in the real estate sectors laying in the bottom quarter of the last 3 years range. And we can't have commercial real estate go into another down leg, because that will do what? It will damage a lot of banks. And Powell glibly said, no, the banks are in great shape. This reminds me of what Bernanke said in 2007 about the mortgage market. No, it's manageable. Well, they may lead it, and then finally people say, hey, what's going on here? We can't ignore this anymore. And when the Fed starts cutting, I said this before many times, that you go back and look at the 2000 top, the dot-com bubble. The market peaked in August 2000, and by the first day of January 2001, moderately off the high, but headed down, the Fed cut rates. They started aggressive rate cuts. Market collapsed all the way down. As soon as they started cutting rates, boom, boom, boom. 2007, they printed the top. Mid-September 2007, they cut rates by half a basis point. The market peaked 3 to 4 weeks later and collapsed during a whole cycle of rate cuts. So if you're cheering the possibility of rate cuts, do your history. When the Fed cuts rates, they're panicked. They may not admit it, but they're panicked.
In the 21st century, gold prices have responded to financial crises, geopolitical instability, and shifts in global economic dynamics. Despite fluctuations, gold remains a prized asset for its intrinsic value and role as a hedge against uncertainty. Do you believe gold and silver will continue to rise? Or are there other factors that might influence their trajectory? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.